Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley's CIO and Chief U.S. Equity Strategist. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about the recent equity market correction and whether it's time to step in. It's Monday, August 5th at 11:30 a.m. in New York. So let's get after it. Over the past several weeks, global equity markets have taken on a completely different tone, with most major averages definitively breaking strong uptrends from last fall. Many are blaming the Fed's decision last week to hold interest rates steady in the face of weaker jobs data, while others have highlighted the technical unwind of the Japanese yen carry trade. However, if we take a step back, this topping process began in April, with the first meaningful sell-off since last October's lows. Even as many stocks and indices rallied back to new highs this summer, the leadership took on a more defensive posture, with sectors like utilities, staples, and even real estate doing better than they have in years. As I've been discussing on this podcast, this shift in leadership has coincided with softer economic data during the second quarter. This softness has continued into the summer, with the all-important labor market data joining in, as already noted. This rotation was an early warning sign that stocks were likely vulnerable to a correction, as we highlighted in early July. After all, the third quarter is when such corrections tend to happen seasonally for several reasons. This year has turned out to be no different. The real question now is what's next and when will this correction become a buying opportunity? Lost in the blame game is the simple fact that valuations reached very rich levels this year, something we've consistently discussed in our research. In fact, this is the main reason we have no upside to our U.S. major averages over the next year, even assuming our economists' soft landing base case outcome for the economy. In other words, stocks were priced for perfection. Now, with the deterioration in the growth data and a Fed that is in no rush to cut rates proactively, markets have started to get nervous. Furthermore, the Fed tends to follow two-year yields, and over the last month, two-year Treasury yields have fallen by 100 basis points, and are now almost 170 basis points below the Fed funds rate. What this means is that the market is telling the Fed that they are way too tight and they need to cut more aggressively than what they have guided. The dilemma for the Fed is that the next meeting is 6 weeks away, and that's a lifetime when markets are trading like they are today. Markets tend to be impatient, and so I expect that they will continue to trade with high volatility until the Fed appeases the market's wishes. The flip side, of course, is that the Fed does an intra-meeting rate cut, but that may make the markets even more nervous about growth, in my view. Bottom line, markets are likely to remain vulnerable in the near term until we get better growth data or more comfort from the Fed on policy support, neither of which we think is forthcoming soon. Finally, support can come from cheap valuations, but we don't have that yet at current prices. As of this recording, the S&P 500 is still trading 20 times forward 12-month earnings estimates. Our fair value multiple, assuming a soft landing outcome on the economy, is closer to 19 times, which means things aren't actually cheap until we trade 17 or 18 times, which is more than 10% away from where we're trading today. In the meantime, we continue to recommend more defensive stocks in sectors like utilities, healthcare, consumer staples, and some real estate. Conversely, we continue to dislike smaller cap cyclical stocks that are most vulnerable to the current growth slowdown and tight rate policy. Thanks for listening. If you enjoy the podcast, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.